And thank you, everybody, again for joining us on a very busy week, and I'm sure a very busy Friday afternoon for all of you. My name is Scott Martin. I'm Chief Investment Officer of Kingsview Wealth Management and also a portfolio manager within the Kim portfolios. And I help lead the investment committee, members of which are on this call and will also be speaking very shortly. One thing I wanted to share with everybody, besides the fact, as I mentioned, that we're all very busy these days and I'm sure a little stressed, but I do want to just give some words of encouragement and certainly some words of acknowledgement to all you out there, because these are times that clients really need us. Sometimes when the markets aren't doing much or the markets are just kind of trending up or just kind of boring, I think sometimes, you don't hear much from clients, nor do we sometimes reach out to clients. But during this period of time when everybody's nervous, certainly this is becoming a one-of-a-kind event, given that you have an economic event on top of a medical event with the coronavirus spreading. So this is the time, everyone, that the clients really need us and need our direction. They need our calming sense, and they also need our advice when it comes to even simple things like what they should be doing in their normal daily lives as far as budgeting, all the way to planning for retirement and or planning for income. So as we kind of, I think, go through these periods of time, it gives us a chance to really reaffirm and reestablish our value to the client. So one thing that we've been really encouraging everybody to do is reach out to clients as much as you can. Be there for them. Understand that clients are going to be volatile at times, just like the markets are. It's a very emotional time, but we've got to be that steady hand, and we've got to be that professional and expert that takes care of their situation and puts them at ease. So with that, we're going to have some speakers today that I'm very excited to hear from, and they'll also share some information with you that hopefully you can pass along to the clients as well, that will be of particular note and of some reassurance. The first person who's going to speak today is Paul Nolte. Paul Nolte is a Senior Vice President and Portfolio Manager at Kingsview Wealth Management and a Portfolio Manager within Kingsview Investment Management and a member of the Investment Committee. And Paul keeps very good track of a lot of the economic data points and data sets that we look at on the Investment Committee when it comes to implementing our portfolio positions. So Paul, if you could just give us an update on the state of the union, as it were, some of the latest economic data points, an outlook as clear as it can be, and I'll turn it over to you.
All right, good afternoon, everyone. Thank you, Scott. And as most everybody knows, there's not a ton, unfortunately, not a ton of data points yet. There's a ton of speculation. We did get some housing numbers this week. They were actually very good. But the one that we were really kind of focused in on is the weekly jobless claims. That jumped as was expected, and the discussion now is around how much more will it jump? How much will GDP contract? How much will businesses fall off? So there's a lot of questions, and unfortunately, we're really not going to be able to readily assess any of that with any intelligence for probably the next 3 to 4 weeks. And that's part of the reason why the markets are reacting the way they are, because they have nothing to grab a hold of from an economic perspective, certainly from an earnings estimate perspective, because we really don't have any earnings coming out at this point, and we won't until mid-April, early mid-April. And we have obviously shutting down of different states, a lot of people not moving around, so you have a lot of emotion going on as well. So the normal tactic is to say, sell everything, put me in cash, and I'm done. At least I don't have to worry about it. So Alex, if you can flip to the next slide, please. So what I wanted to do is kind of move away from the economic part of it and go to where are we today? We all, I think, feel that at some point, whether it's in the next month, 3 months, 6 months, maybe even a year, we're going to get back to something that passes for normal. And what I've got here is just a chart that kind of highlights the market and market returns. And this is based on earnings estimates and earnings, actual earnings of the S&P 500. And then what I've done is, with the red band and the green band, put on a 20 multiple for red and a 10 multiple for green. And the blue is actually the 5-year rate of return for the S&P 500. So as they go higher, as those lines go higher, on the left-hand side, you can see they were up about 15 to 30%. What that's telling you is the forward returns, and this is one of the things that we use in our analysis in trying to construct the portfolios, the forward returns look fabulous. And it was a great time to be investing in the early 80s, into mid-80s. But then you saw those lines drop down. So starting in about 1995 to 1997, it was actually projecting that the returns, even at a 20 multiple, were going to be negative. That the markets had gotten so far ahead of earnings that the projection for the next 5 years is going to be negative. You can see the spike higher, and the spike higher is the decline in 2000, the bottom in March of 2009. Now, note their earnings on the S&P 500 were $10. So we had collapsed entirely. But what we do is we take a look at the highest earnings estimate, or highest actual earnings in history. And in most cases, it's the most recent quarter. Then we gross that up and we assume about a 6% actual compounded growth rate for earnings. And take a look at that over a period of time for our estimates going forward. And so the assumption is that at some point, we're going to get back and recover those earnings, and we're going to set new all-time highs in earnings somewhere in the future. And so if we look at that today, and we've just come off a period where the returns weren't that great looking forward, and that big spike down is the last month, actually the last 2 months, and you can see just on the far right-hand side of that graph, they both spiked higher. So assuming we get to, say, a 10 multiple 5 years from now, your return is essentially 0. Anything above a 12 PE 5 years from now, if the market is at a 12 PE, your return is going to be in excess of a 5-year treasury, for comparison's sake. So the question becomes, should I just put it all in bonds and forget about it, or should I put it in the market? Well, what we're suggesting is that right now, given the decline that we've had in the market, the forward rates of return look very, very good from this point. So as the markets decline, and this is the odd part of it, as the markets decline, that forward return goes higher and higher, and you can see that as the market spiked heading into the bottom of March of 2009. One other point, and then I'll switch it back to Scott, is we've had now, since the Depression, this is the 6th time that we've seen a market decline of greater than 30% in a relatively short period of time. Outside of the Depression, the recovery back to the all-time highs is roughly 5 years. So assuming that we are not going to go into a depression and something that's going to last a very long time, and certainly in that case you were talking about something that lasted 3 to 7 years. This is more of a government shutdown that we expect to turn the spigots back on again at some point here soon. That average return back to the all-time highs is 5 years. If we look at where the market is today, and assuming a 5-year back to the all-time highs, you're looking at a 7.5% compounded on the equity side. If we get there in 3, and we certainly have done that in the past, you're looking at 12.25% from where we are today to the all-time highs just 5 weeks ago. So my point is that as bad as things look today, and they certainly don't look terrific, as long as we get through the summer months and we get back to business as usual, even if it's sometime in the fall, we expect to see those earnings pick up. We'll expect to see the stock market pick up, and we'll start to realize those rates of return from what is right now a reasonably low valuation level. So with that, Scott, I'll turn it back to you, and we'll pass it along to the next one.
Thanks, Paul. That's great information. And one thing that I think's important to point out that Paul highlighted was that these markets at times do get stretched, both to the upside and downside. And one thing to think about is that, when we're in these periods and it feels like we're never going to get out of it, or it's going to get progressively worse and it's never going to get better again, as Paul's graphs show, it does. And so, the good part about this, even though, as Alex mentioned, is another tough day, is we are a day closer to the end of this terrible, very moody, violent market. So if we can just kind of keep our heads about ourselves and do what we can for our clients, especially on the service side, I think that's really how we're going to come out ahead here. So, Paul, I appreciate that insight. And as you noted, there's going to be great bargains and good returns to be had at some point in the near future or distant future, depending on how you look at it. So with that, the next speaker that I'm excited to turn the mic over to is Buff Dormeyer, who's a member of the investment committee. Buff is a relatively recent addition to Kingsview, coming over from a firm beforehand, and he is in Fort Wayne, Indiana, so he's in the Midwest along with us. Buff is a chartered market technician and also sits on the investment committee and helps us with some of these, certainly these crazy markets, but also in some more, let's say, tamer markets when it comes to just figuring out levels of important inflection and levels of support, levels of resistance, as well as other chart patterns to look at when it comes to what a stock, an ETF, or a mutual fund may be doing when it comes to how it's performing and what some of the indicators are saying on the charts when it comes to is it going up or down and what's the outlook. So, Buff, I think there's nobody better to really step in here and talk about these current markets, given how wild they are and how much volatility we're seeing. So I'll turn it over to you to make some sense of the charts.
Thank you, Scott. As Paul was saying, presently known economic and fundamental data is being cast aside, while the forthcoming economic and fundamental data is understandably being met with tremendous uncertainty right now. So in the void of data or even usable data analysis methods, often people's worst nightmare are becoming the base case scenario right now. My approach will continue to be that which has worked well for me in the past, and that's following the money. Following the big institutions, the firms with the most capital, employing the sharpest minds, leads to a clear path. So let's take a look at some of these graphs, and let's do just that. So starting with this first slide, slide number 7, there are many big technical events occurring these past few weeks since we last talked. Last time we discussed about 27.50, 27.5 being important actually triple layer support. Since then, after testing 27.50 a few times, last week the market sliced through this long-standing support at 27.25 like a hot knife on warm butter and fell another 10+%. The most critical event in my work, though, was the trend of money flow. And that has turned negative as of last week. Last week we saw large outflows of capital, but there's some hope, and there's also some things to be very positive about. So if you see the arrow on the very bottom, that shows last week the outflows becoming negative. But if you were to take that back, you would have to go back just to August of 19, when the capital flows were this low. Whereas if you were to look at the price chart, you have to go back to December of 18's pullback to find that point, and then later this week we went to August of 2016 on a price point. So the capital flows are only back to August of 19, whereas the price pullback is way back to 2016 now. And so what that tells us is that the capital flows, although they are trending down and are negative, the big money, the smart money, seems to be trying to wait this out. The smart money is right now not likely to be a willing seller, but at the same point, they have not proven themselves to be an eager buyer either. So what's happening with the smart money, the people that we want to emulate and follow, they seem to be perched on the sidelines right now, watching this chaos unfold and awaiting their next move. So patience is what the market is calling for right here. So let's move to the next slide. We'll make a couple more observations that confirm these same points. Okay, first notice that we have on the first chart, you can see that long-standing trend line going back even past 2009, that the S&P has been in this channel. Okay, now what the important piece of data I want you to look at is this middle slide here, the one that says advanced minus decliners. The advanced decline line measures how many stocks are up versus down, and then it's accumulated over time. The fact that the AD line is holding up and is still above trend suggests the market still has liquidity or the fuel to move higher. The graph above the AD line, which says percentage of new highs, that has not turned up yet, nor has the slide on the very bottom, which is how many stocks are above trend. Both of these are in bottoming out levels, but neither has indicated a turn. And so on my final slide here, we're going to make a couple of observations again about the price trend. So if you look at those gray lines again, that is that long trend standing channel that the market's been in going back to 2009. Those gray lines are bracketing the S&P 500. Okay, below those horizontal channel lines, the trending lines are the horizontal lines. Okay, and so the next resistance point that I have laid out on the chart is 2,550. Okay, that was a former support, now is going to act as resistance. So the major resistance, of course, was the 27.25. Then above that is 25.50. That is our next target on the way up. Now, if we move to the bottom, where is the next floor? The very line on the bottom is 21.75. That's the horizontal major support on the bottom. Today, we closed right around 2,300, close to the midpoint of 2,350, and earlier this week we hit a low of 2,280. So 2,280 would be the shorter term support, and the midpoint of 2,350 will act as some point of resistance here. But the big trading range right now is between the 2,550 and the 2175. Now, the Fed is throwing everything at this market. As you know, they're cutting rates, engaging in repo, mortgage-backed markets, giving interest rate guarantees, quantitative easing. Seemingly nothing is slowing this decline. But take a step back and look at the strong, healthy economy we had coming into this, and then combine it with the strength of the market internals that I'm showing you today and the strength of the market internals prior to the breakdown. I believe all this aforementioned stimulus can act as rocket fuel when the market turns up and the cloud of uncertainty transforms into rays of hope. Blink and you're going to likely miss the run-up. However, as of now, the big money may be nibbling, but they've not stepped in yet, at least not much. So my recommendation is to do the same. Don't be in a rush. Work in cash slowly until we have a clear sign that the smart money is behind us. That concludes what I had to say,
Okay.
fellas.
Yeah, thanks, Buff. It looks like I may have lost Scott here. Hold on, Scott, are you still there?
I got it. Yeah, you just muted me. That's all right. I was just saying to Buff, your credit, you put so much data into a very digestible, understandable format. So we really appreciate that. And certainly in times like these, it's really good to have you as part of our team, because I think, as you noted, as these markets get volatile, as levels get broken and or newly created, it's very valuable to have somebody with your skill set on our team to help us and our advisors with positioning client accounts based on some of the very important and in-depth technical analysis that you have there. So next, I'd like to, Alex, if you just go back to the fixed income update, that's perfect. We have a special guest today, David Summers from Arcadios, as Alex mentioned, to give a fixed income update. David Summers is partners with a fellow by the name of Ross Nelson, who is a bond expert. Both of these guys are bond experts, and they are basically our go-to people when it comes to individual bonds or laddered bond portfolios, or frankly, any commentary or any kind of opinions that we tend to want to receive on the bond market as to how things are trading, how interest rates are behaving, how liquidity is, etc. We go to David and Ross to basically explain and get their opinion on how things are looking. And also, as many of you advisors know, David and Ross also build portfolios for us on the individual bond side, which he'll talk more about. So we are very happy to have them as a resource, as a partner, and we've worked with them for many, many years, and they've been a great asset to our client portfolios as we build out the complete asset allocation to achieve our client goals. So David, with that, I'll turn over the mic to you if you want to talk a little bit about Arcadios and Ross as well, and then if you want to go into your value add a little bit, and then just finish up with maybe a quick update or a quick rundown on what you see going on in the fixed income markets, including some of the liquidity concerns that people have. That would be great.
You got it. And thank you very much, Scott, for that very kind introduction, as well as allowing us the time here to speak to you and your team. It has been a crazy week. I get a few people that say, well, this must not be nearly as bad for you because you're on the bond side. That must be a lot better. And that maybe in some cases is true. That's not true over the past couple of weeks, and this week was proving to be actually the more difficult of the weeks with navigating this market. But to give you a background on it, on what it is that Ross and I do and our team over here at Arcadios is that we work and partner with investment advisory firms across the country. We tend to help them almost try to serve as a fixed income department, fixed income desk, and involve ourselves into calls like this, involve ourselves in investment committee, and then also helping them build out individual bond portfolios if it is deemed appropriate for the client, the view as the advisor. So you work with us to be able to do that, and we hopefully are able to try to find portfolios for you that might exhibit some lower volatility, or that's kind of hard to do in today's market for sure. So what I would, I'm sorry, just a little bit of noise here. Sorry about that. So what I wanted to do is just to go forward and just talk about what it is that we're seeing in the markets here. This illiquidity has really been the major driver of what is causing the markets to have a lot of dislocations to it. You're seeing some extraordinary moves in various asset classes and the fixed income side. I'm going to point out in particular the municipal bond side, because munis historically are supposed to be a little bit more of a safe haven than say corporate bonds or the like. And in fact, we started seeing that a little bit. If you were to look at the 10-year muni bond, it began the year, and this is a AAA bond, it began the year at about a yield of about 1.5%. And then on March 9th, it got down to about 0.8%, about 80 basis points going out 10 years. And since that point, we have been seeing yields widen out by 5 basis points, 15 basis points, 25, 30, and as recent as yesterday and today, 50 basis points of yield expansion. So on March 9th, we were at, as I said, 81 basis points of the yield of the AAA muni. It is now today, at close, almost 2.9%. So 43 basis points wider on the day, and about 100 basis points wider over the past 2 or 3 days. Extraordinary moves, and probably, and certainly moves that I have not seen in my career. And I've been doing, working with this kind of industry and market for the better part of 20, 25 years. So I don't remember seeing moves as volatile as this. So why? You know, and the reason for it is just the pure liquidity. You have a large amount of individual bonds that are being put to market either by bond funds or ETFs, SMA managers, or just individual households. And so they are putting a lot of those out to market, and there's nobody there on the other side to be buying. You're seeing banks not doing a lot of buying, in part because they're not allowed to have, some of these places aren't allowed to have prop desks anymore because of the Volcker rule. So they're not doing a lot of buying. They have to be buying it for their investment accounts. They can do that. You don't have, the individuals aren't wanting to be buying it because they're having those net outflows on these. Obviously, they're the ones that are selling it. So with you have a large amount of sellers, and you know, I think the outflows on the muni side were the widest, were the largest in its history as ICI was recording it, and it beat the second largest outflows by like a factor of 4. So we've had an extraordinary amount of outflows on this. And so you're just going to cause bid-ask spreads to widen out. You're going to cause ETF discounts to widen out to, in some circumstances, to just absurd levels. And what needs to try to figure out is a way to get this liquidity, this market to be working again. But with that, I would say this, though. With that, I do believe that there's opportunity. You know, for a buy and hold investor, we're seeing yields on munis, and this is, you could be talk about this on corporate bonds for best of breed like corporations that are out there. You can be snatching up really good quality corporate bonds and munis at yield levels that we haven't seen in years. We're you know, going out 10 years on a high quality tax exempt muni from like the AA rated or whatnot, going out just 9 years, we're able to pick that up at around a 3.5 to 4%. And we haven't had that kind of level in a really long time. And all this is occurring when the Treasury market extremely volatilely, but they're at sub 1% levels going out 10 years. So the message I would say is that there's opportunity to be able to be selectively buying individual bonds. I'd probably be hesitant to be using ETFs as a source because many of those ETFs are at wide discounts. I'd be less worried about using open-end funds as a source because you are getting full net asset value for them, and you're able to pick up bonds hopefully cheaper on the open market if you can be patient about it. That's kind of from a tactical as well as a 30,000 foot level view is what I'm seeing. So I'm going to give it back to you, Scott, and hopefully answer any questions that might come up.
Yeah, great. Thanks, David. It was great insight. And as we continue to see volatility in the fixed income markets, obviously we will rely on you and Ross and your team to help us navigate the rough waters, which, as you mentioned, are almost just as rough, if not more so, than the equity markets these days. So that's something interesting. Before we get to the questions that Alex will field here, just some closing remarks and thoughts for everybody. One thing is, as you can all see, we have a very deep, well-heeled team here at Kingsview Investment Management, and we have a variety of portfolios, obviously, that we run that fit all kinds of client objectives and risk profiles. And we also just want to be here. So besides being the portfolio managers and being somewhat of a source to come to when you want to outsource the portfolio management, We also want to be here for all of you when it comes to questions or concerns you have about your business or about things that you're thinking about that maybe you're not sure of or want some clarification on, or just even somebody to bounce an idea off of. Please utilize our team. As you can tell, we've got a lot of different skill sets and some great experience on the team here. And our main desire is to help you, help us, help you. And so we're here for you 24/7, 365, just to help you grow your business and run it better and more efficiently so that you can have a better life as an advisor.